Everyone, listen to me right now, because you've been sold the most dangerous lie in modern finance history. They told you that private credit was safe and that you could replace your bonds with this investment that yields 12 to 15%. And then on top of it, they said you've got nothing to worry about because they put terms like this in front of it. They called it senior secured, floating rate, covenant light. And on top of that, they said, look, you've got nothing to worry about because BlackRock manages it. Wrong. That's dead wrong. Because right now, private credit is the single most lethal asset class on earth. And this leverage, illiquid garbage has been running for 2 straight years while they've lied to your face. And BlackRock, they're the 11 trillion pound gorilla that everyone in the finance industry worships. But get this, they just had their Baker CLO fail over collateralization test for 12 straight months. That's right, 12. And right now they're waiving fees because the collateral is so bad, they literally can't pretend anymore. And this is happening, my friends, right now while you're watching this video. And as you're about to see, this is a first domino of many that are about to fall. Plus, tonight's show is brought to you by Newton Golf Company. You can find them on the NASDAQ at the symbol NWTG. And insiders just scooped up a massive pile of shares right after the company dropped its biggest quarter ever. And with the stock rallying off its 10-day volume profile, this is one trade you don't want to miss. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, if you think that this private credit poison is not in your portfolio, and you're about to see it is, and again, this is the first domino of many that are about to fall. If you own any stock fund, any 60/40 portfolio, any target date fund, a pension, an annuity, a BDC, anything sold by Ares, Blackstone, Blue Owl, KKR, or BlackRock, well, your family's retirement is already bleeding and you probably don't even know it yet. And if you think that these investments are safe with stocks sitting at all-time highs, they're not. Because that's what makes this so terrifying, because right now the market is at peak euphoria and we're sitting on the biggest bubble in history in private credit, and it's silently detonating underneath everything you own. Now imagine this, you log into your 401k one day and you see your accounts are taking a hit. You push the sell button, you want to get out, but it says no. So you call your advisor and he says, sorry, the private credit space just got absolutely destroyed. Redemptions, they're gated. You can't get out. There's nothing we can do. Now, my friends, that scenario just isn't possible. It is probable if we stay on this path. Now, buckle up because I'm about to drop 5 nuclear private credit bombs. First up, let's talk about that BlackRock Baker CLO 2021-1. This $495 million deal has been failing over collateralization tests since October of 2024. That's now 12 straight months. And we talked about Renovo Home Partners. Guess who owns them? BlackRock, and they wrote that loan to zero 2 weeks ago. That's right, to zero. And now, BlackRock is waiving fees, something they rarely ever do, because if they didn't, the senior tranches would be eating principal losses right now. And my friends, this is the first publicly documented private CLO over collateralization failure in history. It's the first ever. And you're not even going to believe this. While you're watching this video right now, they're lending even more. More broadly, CLOs backed by either bank loans or direct lenders are on track for another record year. More than 1,000 U.S. CLOs worth more than $470 billion have priced this year, up from last year's record when 947 vehicles printed about $424 billion. My friends, there's another $428 billion of this hiding out, going into portfolios, and people have no clue. And this is insanity. The problem is you're holding the risk. But again, this isn't just a BlackRock issue. The entire market is following us down. Let's take a look at what happened to Blue Owl recently. And if you don't know who they are, they're considered one of the best private credit shops in the business. And right now, their money machine, well, it's sputtering and about to crash. Blue Owl just announced it was scrapping a planned merger of 2 of its private credit funds, backtracking on a plan revealed November 5th after scrutiny arose over potential losses some investors would have to swallow as part of the deal. Now, you read that right. Investors are going to have to eat 20 to 25% of losses on day one. So you know what they did? They said, you know what, we can't do that. We're scrapping the deal. But there's, again, this other problem I've been worrying about. If you think you can get out of these things, you're not. You're trapped. Craig Parker said that the fund has performed well and the Blue Owl will work with the fund's board to figure out a liquidity solution for investors. Translation? Investors are screaming to get out, and they want out now. The problem is there isn't enough money in the fund to pay them. They've already blown through their redemption limit last quarter, and now more people are lining up. So Blue Owl, consider them the gold standard in the industry, is gating and trapping people. What does that mean? That every other fund out there is underwater and drowning fast. And this is why savvy investors want out. They want to get out before you realize it, and they want you to be the one holding the bag unless you act right now. In the third quarter, the vehicle approved about $60 billion of redemptions, exceeding its pre-sent limit. Now, if redemptions start to pick up, which some market participants are expecting to occur, managers may have to gate the fund to block further exits. So here's the deal. They're already planning to lock the doors on these funds, and that's going to trap investors who will be forced to watch their account drop with no options, nowhere to turn. And if you think this can't get worse, it already is. Because Fitch Ratings said U.S. private credit default eased to 5.2% in October, but that's already higher than the broadly syndicated loan market. But check this out. Smaller companies, we're talking under 25 million EBITDA, the default rate is 10.9%. That's triple the average. Again, triple the average. And my friends, as I said, this situation isn't getting better. It's getting worse and fast. Because if we don't have a blockbuster holiday season, and I don't think we're going to, more and more small companies are just going to default. On top of that, well, here, check this out. Fitch said that business development companies, well, they're imploding. Shares of BDCs, which package private loans into funds and often trade publicly, have declined in recent months as investor anxiety over the quality of their portfolios is rising amid recent defaults. Earlier this month, Fitch stamped a, quote, deteriorating outlook on BDCs, citing prolonged asset quality pressures from the challenging economic backdrop. And again, here we're back to this deteriorating outlook. My friends, this is a doom loop, a literal doom loop. And if you think, hey, Steve, don't worry, the Fed will cut rates, it'll get better. No, as you're about to see, if the Fed cuts rates, it's going to get worse, a whole lot worse. Because declining interest rates, another focus for investors, will also fuel additional dividend cuts in coming quarters, according to Fitch. As dividends suffer, BDC's leverage and liquidity levels are likely to follow suit, a dynamic that will test the vehicle's tolerance for mechanisms like PIK. If you don't know what PIK is, it's called payment in kind debt that allows borrowers to push back payments until the debt itself has to be repaid. So get this, if the Fed cuts, and we know they might not in December, but they're probably going to in January, this leverage is going to blow up, liquidity is going to vanish, and your money, it's going to be locked up. No exit, no way out. And payment in kind, it's Wall Street's way of saying, you don't have to make a payment, and that means you're not in default if you don't. But do you understand now why these things just go into default without any warning? It's because of the way they're designed. And a lot of them are going into default next year. According to UBS, private credit defaults could climb by as much as 3 percentage points in 2026. That's right. So we have 8% defaults on a $2 trillion market. That's 160 to 200 billion in losses next year alone. And for context, let's go back to 2009. Leveraged loans, they peaked at 12% default rate. My friends, we're on the same path we were before. We're doing this whole thing again. And you know the experts, they've been calling for a correction in AI stocks? Well, check this out. It's going to have a massive impact. Because AI presents a double-edged sword for private credit, according to UBS. If there's a downturn in AI, as many as 30% of newer firms with private credit could be impaired. Conversely, if AI drives, quote, widespread enterprise disruption, as much as 40% of private credit assets may take a hit. So could you imagine 40% of a $2 trillion market blowing up? Look, my friends, this isn't just possible. In a market correction, or worse, a recession, this all becomes a reality. And if you think the banks are immune to this, not a chance. They're exposed big time. Because banks with assets over $10 billion now have more than $2.2 trillion of exposure to loans to non-bank financial institutions, a figure that's expected to keep rising. So do you see how this goes? First, private credit starts to crash. Investors get gated because they want out and they can't get out. This spills over into the banking system who holds this garbage. Credit dries up, depositors panic, they start to yank funds, and next thing you know, bank insolvencies shoot higher. And this is exactly how we get into a financial crisis, my friends, and you're seeing the beginning of it right now. And this is why Jeffrey Gundlach, the bond king, he even recommends a 20% cash position right now to hedge against a market implosion. And I've been warning about how this market's overvalued and likely to come crumbling down. According to Gundlach, the next big crisis in the financial markets is going to be private credit. It has the same trapeze as subprime mortgage repackaging had back in 2006. So what does this mean for the stock market? A 30 to 40% drawdown? Easy. And my friends, again, this is just the first domino. BlackRock, they're falling. Blue Owl, down. Default, surging. The doom loop, it's starting to spin. And Gudlock, he is screaming fire. And with stocks sitting near all-time highs right now, with the biggest credit bubble in history detonating underneath it, this means everything you own is at risk. And again, that 30 to 40% drawdown, that's base case. If we have a financial crisis, it's going to be even worse. And this, it's all happening right now. So here's the action steps you can take right now. Cut exposure to all BDCs and private credit funds immediately. Move to cash, short-term treasuries. Now, if you're in an illiquid private fund, submit a redemption request this week, even if there's a gate. You gotta get in line. Now, consider cashing in on some of your tech gains on this next rally here. Gunlock, he's saying 20% in cash. And what you can do with that, look to be long the dollar here, because remember, the world is short dollars in a big way. And that means the dollar could take off. And when everyone needs dollars, they're going to scramble for them, and you're going to have them to sell. And treasuries, a solid bet if the Fed's going to cut rates. Maybe not in December, but with the labor market weakening, January is looking to be a lot. You want to hold 6 to 9 months in an emergency fund at a high yield, the highest you can get. And cut your discretionary spending. Tighten up your budget. Because here's the deal. I don't want you to go broke when this happens, and we know the odds of it are high. What I want you to do is get rich when this blows up. Now, let's dive into today's sponsor, Newton Golf Company. Again, you can find them on the NASDAQ and the symbol NWTG, and they are crushing it on the course with their revenues, setting up a big move for their stock. Because Newton Golf is straight up harnessing the power of physics to build the sickest shaft and putters on the planet. These aren't your grandpa's clubs. We're talking longer drives, dead straight ball flight, and putts that roll like they're on rails. This is made in the USA. And check this out. Last year, revenue exploded 887% to $3.45 million. Then the first half of 2025, another 182% jump to $3.3 million. And they just dropped Q3 numbers today, $2.58 million, up 113% year over year, the biggest quarter in company history. That's almost $6 million in the first 9 months, and they're sticking to guidance of $7 to $7.5 million for the full year. This is straight rocket fuel. And the pros are loving it too. Miguel Angel Jimenez is out there winning tournaments and currently leading PGA Tour Champions money list, swinging Newton shafts. Over 50 pros on Champions, LPGA, and Korn Ferry Tours are already gaming them. And when the best in the world switch, you know something special is happening. And here's the absolute fire part. Right after dropping these monster Q3 numbers, CEO Greg Campbell, CFO Jeff Claiborne, and board member Brett Hoge went into the open market and bought 173,548 shares with their own money. Insider ownership just jumped to 8.8%. And you know when the bosses are backing up the truck like that, you know something big is coming. Now they're expanding in Japan and South Korea right now, with new premium shafts dropping in 2026, and the fast motion shaft is still outpacing every previous launch. This thing is just getting started, and what it's doing is setting up a big move for its stock. Let's take a look at the chart because it's got a wildly bullish setup here. Now that red line, that's a 10-day volume profile. And over the last 10 days, buyers have stepped in here. You can see on the earnings, it's jumped. But where do we think this can go? Well, it's got a lot of legs. In fact, the 6-month volume profile is quite a ways up, setting up, again, a big potential move. And if those sales from overseas kick off, you're going to watch this stock go higher and higher. Now keep your eyes locked on Newton Golf. You can find them on the NASDAQ and the symbol NWTG. These guys are swinging for the fences. It looks like they're about to crush it, and you can go along the ride with them. And as always with any company you feature on the show, you're under no obligation to purchase their stock. Be sure to research before placing any trades and use your risk control levels when you do. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.